Hello and welcome. In this course, we will explore impairment of assets based on International Accounting Standard 36. The standard on impairment of assets was first introduced to bring together the rules on how companies should check whether their assets are still recoverable. Originally issued in 1998, it was later adopted in 2001 by the International Accounting Standards Board. Before this, the requirements were scattered across several different standards, making it harder to apply them consistently. Over time, the standard has been updated to reflect changes in accounting practices. In 2004, it was revised as part of the Project on Business Combinations, and again in 2008, further improvements were introduced. In 2013, the standard was updated with new requirements on how companies disclose the recoverable amount of assets when they have been impaired. The changes focused on situations where the recoverable amount is determined using fair value after taking into account the costs of disposal. Companies also needed to provide more details about how that fair value was measured. Over the years, several other accounting standards have also introduced smaller updates to IAS 36. These came alongside the development of new standards on consolidated financial statements, joint arrangements, fair value measurement, financial instruments, revenue recognition, agriculture, and insurance contracts. Each of these changes helped keep IAS 36 aligned with broader improvements in financial reporting. The Standard on Impairment of Assets is a comprehensive document that sets out detailed guidance on how it should be applied. All of its sections carry the same level of importance, and together they form a consistent framework. To fully understand and apply it, the standard should always be considered alongside its overall purpose, the reasoning behind it, and the broader framework of financial reporting. In situations where the standard does not provide direct guidance, accountants are expected to rely on general principles to choose and apply appropriate accounting policies. The main goal of this standard is to guide companies in making sure that their assets are not recorded at an amount higher than what can actually be recovered. An asset is considered to be carried at too high a value if its recorded amount is more than what the company can recover through using or selling it. When this happens, the asset is classified as impaired, and the company must recognize a loss to reflect that impairment. The standard also explains the circumstances under which an impairment loss can be reversed and sets out the information that should be disclosed to provide transparency in financial reporting. This standard applies to the accounting of impairment for most types of assets, but there are several exceptions. It does not apply to inventories, certain contract-related assets recognized under revenue standards, deferred tax assets, or assets connected to employee benefits. Financial assets covered by financial instrument standards, investment property measured at fair value, and certain biological assets in agriculture are also excluded. Additionally, the standard does not apply to assets related to insurance contracts or to non-current assets that are classified as held for sale. These exceptions are designed to ensure that the impairment rules are applied where they are most relevant, without conflicting with other specific standards. The standard does not apply to inventories, assets from construction contracts, deferred tax assets, employee benefit assets, or assets that are classified as held for sale. This is because other existing standards already provide rules for recognizing and measuring these types of assets. However, the standard is relevant for certain financial assets, including subsidiaries, associates, and joint ventures. For all other financial assets, the rules in the Financial Instrument Standard should be followed. Additionally, the standard does not cover investment property measured at fair value or biological assets in agriculture that are valued at fair value after deducting selling costs. These exclusions ensure that the impairment rules are applied consistently and only where appropriate. This standard applies to assets that are carried at a revalued amount, which is the fair value at the time of revaluation minus any depreciation and previous impairment losses. The main difference between fair value and fair value less the costs of disposal is the direct costs involved in selling the asset. If these disposal costs are small, the recoverable amount is usually close to or even higher than the revalued amount, so it is unlikely that the asset is impaired, and no further estimation is needed. However, if the disposal costs are significant, the recoverable amount will be lower than the fair value, and the asset may be impaired if its value in use is less than the revalued amount. In such cases, the standard must be applied to determine whether an impairment loss should be recognized. This standard uses several key terms that are important to understand. The carrying amount of an asset is its recorded value after subtracting any accumulated depreciation or previous impairment losses. A cash-generating unit is the smallest group of assets that produces cash inflows largely independent of other assets or units. Corporate assets are those other than goodwill that contribute to the future cash flows of both the unit being considered and other units. The costs of disposal are the additional costs directly associated with selling an asset or cash-generating unit, not including finance costs or taxes. Finally, the depreciable amount of an asset is its cost, or a substituted amount used in the financial statements minus its residual value. Depreciation or amortization is the process of systematically spreading the cost of an asset over its useful life. Fair value represents the price that could be received to sell an asset or paid to transfer a liability in an orderly market transaction. An impairment loss occurs when the carrying amount of an asset or a cash-generating unit is higher than its recoverable amount. The recoverable amount is the greater of the asset's fair value minus any costs of disposal and its value in use. The useful life of an asset is either the period over which it is expected to be used or the number of production units it is expected to generate. Value in use is the present value of the future cash flows that an asset or cash-generating unit is expected to produce. The standard provides guidance on how to identify assets that may be impaired. Although the text often refers to an asset, the rules apply equally to individual assets and to cash-generating units. The guidance is structured in three main parts. The first part explains when the recoverable amount of an asset should be determined. The second part provides detailed instructions on how to measure the recoverable amount for both individual assets and cash-generating units. The third part focuses on recognizing and measuring impairment losses. It distinguishes between individual assets, excluding goodwill, and cash-generating units or goodwill, providing specific guidance for each. The standard also explains how to reverse an impairment loss that was recognized in previous periods, applying to both individual assets and cash-generating units. There are additional details for individual assets, for cash-generating units, and for goodwill, outlining specific requirements in each case. The standard further sets out what information should be disclosed regarding impairment losses and any reversals, ensuring transparency in financial reporting. Additional disclosure rules apply when cash-generating units include goodwill or intangible assets with indefinite useful lives, providing more detailed information for these specific cases. An asset is considered impaired when its carrying amount is higher than the amount that can be recovered from it. If there are signs that an asset might be impaired, the company must formally estimate its recoverable amount. When no such signs are present, a formal estimate is not required. At the end of each reporting period, the company should review all assets to determine whether any indicators of impairment exist. If any indications are identified, the recoverable amount of the asset must be calculated. In addition, there are certain circumstances where the company must assess assets for impairment, even if no clear indications are present. Intangible assets that have an indefinite useful life, or those that are not yet ready for use, must be tested for impairment at least once a year by comparing their carrying amount with their recoverable amount. This annual test can be done at any point during the year, as long as it is done at the same time each year. Different intangible assets may be tested at different times, but if an intangible asset was acquired during the current year, it must be tested before the end of that year. Similarly, goodwill acquired in a business combination must also be tested for impairment annually, following the specific guidance for goodwill. Intangible assets that are not yet ready for use carry a higher level of uncertainty regarding their ability to generate future economic benefits. Because of this, the standard requires that these assets be tested for impairment at least once a year to ensure their carrying amount is not overstated. When evaluating whether an asset may be impaired, the company should consider a range of possible indicators that could signal a reduction in the asset's recoverable amount. There are several external signs that an asset may be impaired. The asset's value may have fallen significantly more than what would be expected from normal use or the passage of time. Changes in the technological, market, economic, or legal environment, either during the period or anticipated in the near future, can also have an adverse effect. In addition, increases in market interest rates or other investment returns may raise the discount rate used in valuing the asset, which can materially reduce its recoverable amount. Finally, if the total carrying amount of the company's net assets exceeds its market capitalization, this may indicate that some assets are impaired. Internal signs can also indicate that an asset may be impaired. For example, there may be evidence of physical damage or obsolescence affecting the asset. Significant changes in how an asset is used or is expected to be used can also be a warning. This could include the asset becoming idle, plans to discontinue or restructure the operation it supports, intentions to sell the asset earlier than originally planned, or reassessing its useful life from indefinite to finite. In addition, internal reports may show that the asset's economic performance is or will be worse than originally expected. For investments in a subsidiary, joint venture, or associate, receiving a dividend can sometimes indicate that the investment may be impaired. This is particularly the case if the carrying amount of the investment in the investor's separate financial statements is higher than the carrying amounts of the investee's net assets, including any goodwill, in the consolidated financial statements. Similarly, if the dividend exceeds the total comprehensive income of the investee for the period in which it is declared, this may also signal impairment. The examples provided are not exhaustive, and other situations may arise that suggest an asset could be impaired. In such cases, the company must determine the recoverable amount of the asset, or in the case of goodwill, carry out an impairment test following the specific guidance for goodwill. Internal reporting can provide important evidence that an asset may be impaired. For example, if the cash required to acquire, operate, or maintain the asset is much higher than originally planned, this could be a warning sign. Similarly, if the actual net cash flows or operating profit from the asset are significantly worse than expected, it may indicate impairment. A notable decline in projected cash flows or profit, or a sharp increase in expected losses, is also a signal. Additionally, if current operating losses or cash outflows, when combined with future budgeted amounts, show a negative trend, this may suggest that the asset's recoverable amount should be reviewed. The standard requires that intangible assets with an indefinite useful life, assets not yet ready for use, and goodwill be tested for impairment at least once a year. In other cases, the principle of materiality guides whether a company needs to estimate the recoverable amount of an asset. For instance, if prior assessments show that an asset's recoverable amount is much higher than its carrying amount, and no new events have occurred that would reduce this difference, it may not be necessary to recalculate the recoverable amount. Similarly, earlier analyses may indicate that an asset's recoverable amount is not affected by one or more of the potential indicators of impairment. For example, if market interest rates or other investment returns rise during the period, a company may not need to formally estimate an asset's recoverable amount in certain situations. This is the case when the increase in market rates is unlikely to have a significant effect on the discount rate used to calculate the asset's value in use. For instance, a rise in short-term interest rates may have little impact on the discount rate applied to an asset that still has a long, useful life. If the discount rate used to calculate an asset's value in use is likely to be affected by rising market rates, a formal estimate of recoverable amount may still not be necessary in certain cases. This can happen if previous sensitivity analyses show that future cash flows are likely to increase as well, for example, if a company adjusts its revenues to offset higher market rates. It may also apply if any reduction in recoverable amount would not lead to a significant impairment loss. Additionally, if there are signs that an asset might be impaired, this could indicate that its remaining useful life depreciation method or residual value should be reviewed and adjusted according to the relevant accounting standards, even if no impairment loss is ultimately recognized. The recoverable amount of an asset or cash-generating unit is defined as the higher of its fair value less costs of disposal and its value in use. The guidance applies equally to individual assets and to cash-generating units. It is not always necessary to calculate both amounts. If either the fair value less costs of disposal or the value in use exceeds the carrying amount, the asset is not impaired, and there is no need to determine the other amount. In many cases, fair value less costs of disposal can be measured even if there is no quoted price for an identical asset in an active market. However, sometimes it is not possible to reliably estimate fair value due to a lack of market data. In such situations, the value in use may be used as the recoverable amount. If there is no reason to think that an asset's value in use is significantly higher than its fair value less costs of disposal, the fair value less costs of disposal can be used as the recoverable amount. This is often the case for assets held for disposal, since the value in use mainly reflects the net proceeds from selling the asset, and any cash flows from continued use are likely minimal. Recoverable amount is usually determined for an individual asset, unless the asset does not generate cash inflows independently of other assets. In such situations, the recoverable amount is determined for the cash-generating unit that includes the asset, unless the asset's fair value less costs of disposal exceeds its carrying amount, or if its value in use is close to fair value, less costs of disposal and fair value can be reliably measured. In some cases, reasonable estimates, averages, or computational shortcuts can be used to approximate the calculations needed to determine fair value less costs of disposal or value in use. Intangible assets with an indefinite useful life must be tested for impairment at least once a year, regardless of whether there are any signs of impairment. However, the most recent detailed calculation of the asset's recoverable amount from a prior period can be used for the current test if certain conditions are met. These conditions include the asset is part of a cash-generating unit and the composition of that unit has not changed significantly since the last calculation. The previous recoverable amount was substantially higher than the asset's carrying amount, and an analysis of events and changes since the last calculation shows that it is unlikely the current recoverable amount would be less than the carrying amount. When measuring an asset's fair value less costs of disposal, certain costs directly related to the disposal are subtracted, provided they have not already been recognized as liabilities. These costs can include legal fees, stamp duties, taxes related to the transaction, costs of removing the asset, and other direct incremental costs needed to prepare the asset for sale. Costs such as termination benefits or expenses associated with reorganizing the business after the sale are not considered direct disposal costs. In some situations, selling an asset may involve the buyer taking on a liability, and in such cases, a single fair value less costs of disposal may be used for both the asset and the liability. When calculating the value in use of an asset, several key elements must be considered. First, the estimate of future cash flows that the company expects to generate from the asset. Second, any expected variations in the amount or timing of those cash flows. Third, the time value of money, which is typically represented by the current market risk-free interest rate. Fourth, a consideration for the risk or uncertainty inherent in the asset. Finally, other factors that market participants would include when pricing the expected cash flows, such as illiquidity or other market conditions. Estimating the value in use of an asset involves two main steps. First, the company estimates the future cash inflows and outflows expected from the continuing use of the asset and its eventual disposal. Second, an appropriate discount rate is applied to these future cash flows. Factors such as uncertainty, risk, and other market considerations can be incorporated either by adjusting the cash flows themselves or by adjusting the discount rate. Regardless of the method used, the result should reflect the expected present value of the future cash flows, essentially capturing a weighted average of all possible outcomes. Additional guidance on applying present value techniques is provided in the appendix of the standard. When measuring the value in use of an asset, cash flow projections should be based on reasonable and supportable assumptions that reflect management's best estimate of the economic conditions expected over the asset's remaining useful life. External evidence should be given greater weight in forming these assumptions. The projections should rely on the most recent budgets or forecasts approved by management, but should not include estimated cash flows from future restructurings or from enhancing the asset's performance. These projections generally cover a maximum period of 5 years, unless a longer period can be justified. For periods beyond the approved budgets or forecasts, cash flows can be extrapolated using a steady or declining growth rate, unless an increasing rate can be reasonably justified. This growth rate should not exceed the long-term average growth for the relevant products, industries, markets, or countries, unless a higher rate is warranted. Management evaluates the reasonableness of its current cash flow projections by comparing past projections with actual outcomes. This helps ensure that the assumptions used in the current projections are consistent with historical results, while also considering any events or circumstances that have occurred since those actual cash flows were generated. Detailed and reliable financial forecasts extending beyond 5 years are generally not available, so estimates of future cash flows are usually based on the most recent budgets or forecasts covering a maximum of 5 years. However, management may use projections for longer periods if it is confident in their reliability and can demonstrate, based on past experience, that it has accurately forecast cash flows over extended periods. To estimate cash flows for an asset until the end of its useful life, projections are extended from the financial budgets or forecasts using a growth rate for the subsequent years. This growth rate is usually steady or declining, unless objective information about a product or industry life cycle supports an increase. In some cases, the growth rate may be 0 or even negative. When market conditions are favorable, new competitors may enter and limit growth, making it unlikely for an asset to exceed the average historical growth rate over the long term, such as 20 years. When using information from budgets or forecasts, the company must ensure that the assumptions are reasonable and supportable, reflecting management's best estimate of the economic conditions expected over the asset's remaining useful life. Estimates of future cash flows for an asset should include projections of cash inflows from its continued use, as well as the cash outflows that are necessary to generate those inflows. This includes expenses to prepare the asset for use, and these costs should be directly attributable to the asset or allocated on a reasonable and consistent basis. Additionally, any net cash flows expected from the disposal of the asset at the end of its useful life should be included. The assumptions used for future cash flows and the discount rate should be consistent regarding price changes due to general inflation. If the discount rate accounts for general inflation, the future cash flows are estimated in nominal terms. If it does not, the cash flows are estimated in real terms, while still including specific price increases or decreases expected for the asset. Projections of cash outflows should include the costs of day-to-day servicing of the asset, as well as future overheads that can be reasonably attributed to its use. If the asset's carrying amount does not yet reflect all the cash outflows needed before it is ready for use or sale, the estimate should include any additional cash outflows expected to complete the asset, such as a building under construction or a development project still in progress. To avoid double counting, cash flow estimates should not include inflows from other assets that generate largely independent cash flows, like receivables, nor should they include outflows for obligations already recognized as liabilities, such as payables, pensions, or provisions. Future cash flows should be estimated based on the asset in its current condition. They should not include any inflows or outflows expected from a future restructuring that the company has not yet committed to, or from improvements or enhancements to the asset's performance. Since the cash flows reflect the asset as it currently exists, the value in use does not take into account expected cost savings or benefits from uncommitted restructuring, nor does it include future expenditures to enhance the asset or the related additional inflows from those expenditures. A restructuring is a program planned and controlled by management that significantly changes either the scope of the business or the way it is conducted. Guidance from IAS 37 clarifies when a company is considered committed to a restructuring. Once the company is committed, some assets will be affected. At that point, estimates of future cash inflows and outflows for determining value in use should reflect the cost savings and other benefits from the restructuring based on the latest approved budgets or forecasts. In addition, expected future cash outflows for the restructuring are recognized as a provision in accordance with IAS 37. Illustrative examples in the standard show how future restructurings affect value in use calculations. Until a company actually incurs cash outflows to improve or enhance an asset's performance, the expected future cash inflows from those enhancements are not included in the cash flow estimates. Estimates of future cash flows should, however, include any outflows necessary to maintain the economic benefits expected from the asset in its current condition. For a cash-generating unit with assets that have different useful lives, the replacement of assets with shorter lives is treated as part of the ongoing maintenance of the unit when estimating its future cash flows. Similarly, for a single asset made up of components with different useful lives, replacing shorter life components is considered part of the day-to-day servicing when estimating the asset's future cash flows. Estimates of future cash flows should not include cash inflows or outflows from financing activities, nor should they include income tax receipts or payments. The assumptions used in estimating future cash flows must be consistent with the way the discount rate is determined to avoid double counting or ignoring effects. Since the time value of money is reflected through discounting, cash flows exclude financing activities, and because the discount rate is calculated on a pre-tax basis, future cash flows are also estimated before taxes. The net cash flows expected from the disposal of an asset at the end of its useful life should reflect the amount the entity expects to receive in an arm's-length transaction between knowledgeable, willing parties after deducting any estimated disposal costs. This estimate is similar to determining an asset's fair value less costs of disposal. In doing so, the entity considers prices for similar assets that have reached the end of their useful life and have operated under comparable conditions. These prices are then adjusted for expected future price changes, including general inflation and any specific increases or decreases. However, if the estimates of future cash flows from the asset's continued use and the discount rate do not include general inflation, the same exclusion applies to the disposal cash flow estimate. Fair value and value in use are different concepts. Fair value reflects the assumptions that market participants would use when pricing an asset, while value in use reflects factors that may be specific to the entity itself. Fair value does not take into account certain factors that are unique to the current owner. For example, it excludes additional value that comes from grouping assets together, synergies between the asset being measured, and other assets, legal rights, or restrictions specific to the owner, and any tax benefits or burdens that are unique to the owner. Future cash flows should be estimated in the currency in which they are expected to be generated. These cash flows are then discounted using a discount rate that is appropriate for that currency. After calculating the present value, the entity translates it into the reporting currency using the spot exchange rate at the date of the value in use calculation. The discount rate used to measure an asset's value in use should be a pre-tax rate that reflects the current market assessments of the time value of money and the risks specific to the asset, excluding any risks already incorporated in the estimated future cash flows. Essentially, this rate represents the return that investors would expect from an investment with cash flows, timing, and risk similar to those the entity anticipates from the asset. It can be estimated from rates observed in current market transactions for similar assets, or from the weighted average cost of capital of a listed entity with a comparable single asset or portfolio. It is important that the discount rate does not include risks already reflected in the cash flow estimates to avoid double counting. If a directly observable asset-specific rate is not available, the entity may use surrogate measures to estimate an appropriate rate. Impairment losses for individual assets, excluding goodwill, are recognized when the recoverable amount of an asset is less than its carrying amount. In this case, the carrying amount of the asset is reduced to its recoverable amount, and this reduction is recorded as an impairment loss. The loss is recognized immediately in profit or loss unless the asset is carried at a revalued amount under another accounting standard. For a revalued asset, any impairment loss is treated as a revaluation decrease in line with the requirements of that standard. Impairment losses for cash-generating units and for goodwill are treated separately under specific rules. When an impairment loss is recognized on an asset that is not revalued, it is recorded directly in profit or loss. For a revalued asset, however, the loss is recognized in other comprehensive income, but only up to the amount of the revaluation surplus for that asset. Any impairment loss on a revalued asset reduces the corresponding revaluation surplus. If the estimated impairment loss exceeds the carrying amount of the asset, a liability is recognized only if another accounting standard requires it. Once an impairment loss has been recorded, the depreciation or amortization charge for the asset is adjusted going forward to allocate the revised carrying amount, less any residual value, systematically over the remaining useful life. Additionally, any related deferred tax assets or liabilities are calculated based on the difference between the revised carrying amount and the asset's tax base, in accordance with applicable tax accounting standards. Cash-generating units and goodwill are addressed in detail in the standards, which explain how to identify the cash-generating unit to which an asset belongs. They also provide guidance on determining the carrying amount of these units and on recognizing any impairment losses. This ensures that both individual assets and groups of assets, including goodwill, are appropriately tested for impairment, and that any reductions in value are recorded in a consistent and systematic manner. When there is an indication that an asset might be impaired, the entity must first try to estimate the recoverable amount of that individual asset. However, if this is not possible, the recoverable amount should be determined for the cash-generating unit that the asset belongs to. An individual asset's recoverable amount cannot be measured if its value in use cannot be reliably estimated or if the asset does not generate cash inflows independently of other assets. In these situations, the recoverable amount is assessed at the level of the cash-generating unit. For example, a mining entity owns a private railway that supports its mining activities. The railway could only be sold for scrap and does not generate cash inflows independently of the other mining assets. It is therefore not possible to estimate the railway's recoverable amount because its value in use cannot be reliably determined and is likely different from scrap value. In this case, the entity estimates the recoverable amount of the cash-generating unit to which the railway belongs, that is, the mine as a whole. As defined earlier, a cash-generating unit is the smallest group of assets that includes the asset and generates cash inflows largely independent of other assets. Identifying a cash-generating unit requires judgment. If the recoverable amount cannot be determined for an individual asset, the entity identifies the lowest aggregation of assets that produce largely independent cash inflows. For example, a bus company provides services under a contract with a municipality that requires a minimum service on each of 5 separate routes. The assets devoted to each route and the cash flows from each route can be identified separately. However, one of the routes operates at a significant loss. Because the company does not have the option to curtail any one bus route, the lowest level of identifiable cash inflows that are largely independent of cash inflows from other assets is the combined cash inflows generated by all 5 routes. Therefore, the cash-generating unit for each route is the bus company as a whole. Cash inflows include cash and cash equivalents received from parties external to the entity. When determining whether cash inflows from an asset or group of assets are largely independent of other assets, an entity considers factors such as how management monitors operations, by product lines, business units, locations, districts, or regions, or how management makes decisions about continuing or disposing of assets. Illustrative example 1 provides further guidance on identifying a cash-generating unit. If an active market exists for the output produced by an asset or group of assets, that asset or group of assets should be identified as a cash-generating unit, even if some or all of the output is used internally. When cash inflows from any asset or cash-generating unit are influenced by internal transfer pricing, the entity should use management's best estimate of future prices that could be achieved in arm's-length transactions when estimating both the future cash inflows used to determine the assets or cash generating units value in use and the future cash outflows used to determine the value in use of any other assets or cash-generating units affected by the internal transfer pricing. Even if part or all of the output produced by an asset or group of assets is used internally, for example in products at an intermediate stage of production, this asset or group of assets forms a separate cash-generating unit if the entity could sell the output on an active market. This is because the asset or group of assets could generate cash inflows that are largely independent of the cash inflows from other assets or groups of assets. When using information from financial budgets or forecasts related to such a cash-generating unit, or to any other asset or cash-generating unit affected by internal transfer pricing, an entity adjusts the information if internal transfer prices do not reflect management's best estimate of future prices that could be achieved in arm's-length transactions. Cash-generating units should be identified consistently from period to period for the same asset or types of assets, unless a change is justified. If an entity determines that an asset belongs to a different cash-generating unit than in previous periods, or that the types of asset aggregated for the asset's cash-generating unit have changed, disclosures about the cash-generating unit are required if an impairment loss is recognized or reversed. The recoverable amount of a cash-generating unit is the higher of the unit's fair value less costs of disposal and its value in use. For the purpose of determining the recoverable amount of a cash-generating unit, any reference to an asset in paragraphs 19 to 57 is read as a reference to the cash-generating unit. The carrying amount of a cash-generating unit shall be determined consistently with the way its recoverable amount is measured. It includes the carrying amount of only those assets that can be attributed directly or allocated on a reasonable and consistent basis to the cash-generating unit, and that will generate the future cash inflows used in determining the unit's value in use. The carrying amount does not include the carrying amount of any recognized liability unless the recoverable amount of the cash-generating unit cannot be determined without considering that liability. This is because the fair value less costs of disposal and the value in use of a cash-generating unit are determined excluding cash flows that relate to assets that are not part of the cash-generating unit and liabilities that have already been recognized. When assets are grouped for recoverability assessments, it is important to include in the cash-generating unit all assets that generate or are used to generate the relevant stream of cash inflows. Otherwise, the cash-generating unit may appear to be fully recoverable, when in fact an impairment loss has occurred. In some cases, although some assets contribute to the estimated future cash flows of a cash-generating unit, they cannot be allocated to the unit on a reasonable and consistent basis. This might be the case for goodwill, or corporate assets such as head office assets. Paragraphs 80 to 103 explain how to deal with these assets when testing a cash-generating unit for impairment. It may be necessary to consider certain recognized liabilities when determining the recoverable amount of a cash-generating unit. This situation can arise if the disposal of the unit would require the buyer to assume the liability. In such cases, the fair value less costs of disposal or the estimated cash flow from ultimate disposal of the cash-generating unit is determined as the price to sell both the assets of the unit and the liability together, less the costs of disposal. To make a meaningful comparison between the carrying amount of the cash-generating unit and its recoverable amount, the carrying amount of the liability is deducted when determining both the unit's value in use and its carrying amount. Let's have a look at this example. A company operates a mine in a country where legislation requires the owner to restore the site once mining operations are completed. The cost of restoration includes replacing the overburden, which must be removed before mining can begin. A provision for the costs to replace the overburden was recognized as soon as the overburden was removed, and this amount was included in the cost of the mine and is being depreciated over its useful life. The carrying amount of the provision for restoration costs is 500 currency units, which equals the present value of the restoration costs. The entity is testing the mine for impairment, and the cash-generating unit for the mine is the mine as a whole. The company has received various offers to buy the mine at a price of around 800 currency units, reflecting the fact that the buyer would assume the obligation to restore the overburden. Disposal costs for the mine are negligible. The value and use of the mine is approximately 1,200 currency units, excluding restoration costs, and the carrying amount of the mine is 1,000 currency units. The cash-generating unit's fair value less costs of disposal is 800 currency units, which takes into account the restoration costs that have already been provided for. Consequently, the value in use for the cash-generating unit is determined after considering the restoration costs and is estimated to be 700 currency units, which is 1,200 less 500. The carrying amount of the cash-generating unit is 500 currency units, calculated as the carrying amount of the mine 1,000 less the provision for restoration cost 500. Therefore, the recoverable amount of the cash-generating unit exceeds its carrying amount. For practical reasons, the recoverable amount of a cash-generating unit is sometimes determined by taking into account assets that are not actually part of the unit, such as receivables or other financial assets, or liabilities that have been recognized, such as payables, pensions, and other provisions. When this approach is used, the carrying amount of the cash-generating unit is adjusted by adding the carrying amount of these additional assets and subtracting the carrying amount of the relevant liabilities. For the purpose of impairment testing, goodwill acquired in a business combination is allocated from the acquisition date to each of the acquirer's cash-generating units or groups of cash-generating units that are expected to benefit from the synergies of the combination, regardless of whether other assets or liabilities of the acquiree are assigned to those units or groups. Each unit or group of units to which the goodwill is allocated should represent the lowest level within the entity at which the goodwill is monitored for internal management purposes and must not be larger than an operating segment as defined by IFRS 8 operating segments before aggregation. Goodwill recognized in a business combination represents the future economic benefits arising from other assets acquired that are not individually identified and separately recognized. Unlike other assets, goodwill does not generate cash flows independently and often contributes to the cash flows of multiple cash-generating units. In some cases, goodwill cannot be allocated on a non-arbitrary basis to individual cash-generating units and can only be allocated to groups of cash-generating units. Consequently, the lowest level within the entity, at which goodwill is monitored for internal management purposes, may comprise several cash-generating units, to which the goodwill relates but cannot be individually allocated. Therefore, references to a cash-generating unit to which goodwill is allocated, as noted in paragraphs 83 of 99 and Appendix C, should also be understood to include groups of cash-generating units. Applying the requirements in paragraph 80 ensures that goodwill is tested for impairment at a level that aligns with how an entity manages its operations and where the goodwill would naturally be associated. This means that developing additional reporting systems is generally unnecessary. It is important to note that the cash-generating unit to which goodwill is allocated for impairment testing may not correspond to the level used under IAS 21, the effects of changes in foreign exchange rates, for measuring foreign currency gains and losses. For instance, if IAS 21 requires allocating goodwill to relatively low levels for foreign currency measurement, the entity is not required to test goodwill for impairment at that same level unless it also monitors the goodwill at that level for internal management purposes. If the initial allocation of goodwill acquired in a business combination cannot be completed before the end of the annual period in which the combination occurs, the allocation must be completed before the end of the first annual period beginning after the acquisition date. In accordance with IFRS 3 business combinations, when the initial accounting for a business combination can only be determined provisionally by the end of that period, the acquirer records the combination using these provisional values. Any subsequent adjustments arising from completing the initial accounting within the measurement period, which cannot exceed 12 months from the acquisition date, are then recognized. In circumstances where it is not possible to complete the initial allocation of goodwill recognized in a business combination before the end of the annual period in which the combination occurs, the entity must disclose the information required by paragraph 133. If goodwill has already been allocated to a cash-generating unit and the entity disposes of an operation within that unit, the goodwill associated with the disposed operation is included in the carrying amount of that operation when determining the gain or loss on disposal. This goodwill is measured based on the relative values of the disposed operation and the portion of the cash-generating unit that is retained, unless the entity can demonstrate that another method better reflects the goodwill associated with the operation disposed of. For example, if an entity sells an operation that was part of a cash-generating unit to which goodwill has been allocated for CU 100, and the goodwill cannot be non-arbitrarily identified or associated with an asset group at a level lower than the unit, the allocation of goodwill for the disposed operation is based on relative values. If the recoverable amount of the portion of the cash-generating unit that is retained is CU 300, then 25% of the goodwill allocated to the cash-generating unit is included in the carrying amount of the operation sold. This ensures that the gain or loss on disposal appropriately reflects the portion of goodwill associated with the operation. If an entity reorganizes its reporting structure in a way that changes the composition of one or more cash-generating units to which goodwill has been allocated, the goodwill must be reallocated to the affected units. This reallocation is performed using a relative value approach, similar to the method applied when an entity disposes of an operation within a cash-generating unit, unless the entity can demonstrate that an alternative method more accurately reflects the goodwill associated with the reorganized units. For example, if goodwill had previously been allocated to cash-generating Unit A and cannot be non-arbitrarily identified or associated with an asset group at a level lower than A, and Unit A is to be divided and integrated into 3 other cash-generating units B, C, and D, the goodwill is reallocated to units B, C, and D based on the relative values of the 3 portions of A before they are integrated with B, C, and D. When goodwill relates to a cash-generating unit but has not been specifically allocated to that unit, the unit must be tested for impairment whenever there is an indication that it may be impaired. This is done by comparing the carrying amount of the unit, excluding any goodwill with its recoverable amount, and any resulting impairment loss is recognized in accordance with the relevant requirements. If the cash-generating unit includes an intangible asset with an indefinite useful life, or one that is not yet available for use, and that asset can only be tested as part of the unit, the entire unit must be tested for impairment annually. For a cash-generating unit to which goodwill has been allocated, impairment testing must occur annually, and also whenever there is an indication of potential impairment. The carrying amount of the unit, including the goodwill, is compared with its recoverable amount. If the recoverable amount exceeds the carrying amount, the unit and the allocated goodwill are not considered impaired. If the carrying amount exceeds the recoverable amount, the entity recognizes an impairment loss following the specified requirements. The annual impairment test for a cash-generating unit to which goodwill has been allocated can be performed at any point during the year, as long as it is conducted at the same time each year. Different cash-generating units may be tested at different times. However, if some or all of the goodwill allocated to a unit was acquired in a business combination during the current annual period, that unit must be tested for impairment before the end of that period. When the assets within a cash-generating unit are tested at the same time as the unit containing the goodwill, the individual assets must be tested for impairment before testing the unit as a whole. Similarly, if a group of cash-generating units containing goodwill is tested at the same time as its individual units, the individual units must be tested for impairment before testing the group containing the goodwill. When performing an impairment test on a cash-generating unit that has goodwill allocated to it, there may be indications that an individual asset within that unit is impaired. In such cases, the entity must first test the individual asset for impairment and recognize any impairment loss before testing the cash-generating unit containing the goodwill. Similarly, if a cash-generating unit within a group of units containing goodwill shows indications of impairment, the entity tests that individual unit first and recognizes any impairment loss before testing the entire group of units to which the goodwill is allocated. The most recent detailed calculation of the recoverable amount of a cash-generating unit with allocated goodwill may be used for the current period's impairment test if certain conditions are met. These conditions are that the assets and liabilities comprising the unit have not changed significantly since the previous calculation. The prior recoverable amount exceeded the unit's carrying amount by a substantial margin, and after analyzing events and changes in circumstances since the last calculation, the likelihood that the current recoverable amount would be less than the carrying amount is considered remote. Corporate assets are assets such as a headquarters building, divisional facilities, EDP equipment, or a research center that serve the entity as a whole rather than generating cash inflows independently. Whether an asset qualifies as a corporate asset depends on the entity's structure. The key characteristic of corporate assets is that their carrying amount cannot be fully attributed to a specific cash-generating unit. Since corporate assets do not generate separate cash inflows, their recoverable amount cannot be determined individually unless management decides to dispose of them. Therefore, if there is an indication of impairment, the recoverable amount is assessed at the level of the cash-generating unit or group of units to which the corporate asset contributes, and any resulting impairment loss is recognized in accordance with paragraph 104. Because corporate assets do not generate cash inflows independently, it is not possible to determine the recoverable amount of an individual corporate asset unless management has decided to sell or dispose of it. Consequently, when there is an indication that a corporate asset may be impaired, the recoverable amount is assessed at the level of the cash-generating unit or group of cash-generating units to which the corporate asset contributes. This recoverable amount is then compared with the carrying amount of the relevant unit or group, and any resulting impairment loss is recognized in accordance with paragraph 104. Corporate assets do not generate separate cash inflows, so the recoverable amount of an individual corporate asset cannot be determined unless management has decided to dispose of it. Therefore, if there is an indication that a corporate asset may be impaired, the recoverable amount is assessed at the level of the cash-generating unit or group of cash-generating units to which the corporate asset belongs. This recoverable amount is then compared with the carrying amount of the relevant unit or group, and any resulting impairment loss is recognized in accordance with paragraph 104. An impairment loss for a cash-generating unit, which is the smallest group of units to which goodwill or a corporate asset has been allocated, is recognized only if the recoverable amount of the unit is less than its carrying amount. The impairment loss is allocated first to reduce the carrying amount of any goodwill allocated to the unit, and then to the other assets of the unit on a pro rata basis according to their carrying amounts. These reductions are treated as impairment losses on the individual assets and are recognized in accordance with paragraph 60. When allocating an impairment loss in accordance with paragraph 104, an entity must ensure that the carrying amount of an individual asset is not reduced below the highest of its fair value less costs of disposal, if measurable, its value in use if determinable, or zero. Any portion of the impairment loss that would otherwise have been allocated to that asset is instead allocated pro rata to the other assets of the cash-generating unit or group of units. If it is not practicable to estimate the recoverable amount of each individual asset within the unit, the standard requires an arbitrary allocation of the impairment loss among the assets, excluding goodwill, because all assets of the cash-generating unit function together to generate cash inflows. If the recoverable amount of an individual asset cannot be determined, an impairment loss is recognized for that asset only if its carrying amount exceeds the higher of its fair value less costs of disposal and the amount determined through the allocation procedures described in paragraphs 104 and 105. However, no impairment loss is recognized for the asset if the related cash-generating unit is not impaired, even in cases where the asset's fair value less costs of disposal is less than its carrying amount. A machine has suffered physical damage but is still operational, although its performance has declined. Its fair value less costs of disposal is lower than its carrying amount, and it does not generate cash inflows independently. The smallest identifiable group of assets that includes the machine and generates largely independent cash inflows is the production line to which the machine belongs. Under the first assumption, budgets and forecasts approved by management reflect no commitment to replace the machine. In this case, the recoverable amount of the machine cannot be estimated because its value in use can only be determined as part of the production line, and the production line as a whole is not impaired. Therefore, no impairment loss is recognized for the machine, although the entity may need to adjust its depreciation period or method to reflect the expected remaining useful life or consumption pattern of economic benefits. Under the second assumption, management's budgets and forecasts reflect a commitment to replace and sell the machine in the near future, meaning cash flows from its continuing use are negligible. In this scenario, the machine's value in use can be estimated close to its fair value, less costs of disposal, and because this value is below the carrying amount, an impairment loss is recognized for the machine. After applying the allocation requirements for an impairment loss as described in paragraphs 104 and 105, a liability is recognized for any remaining portion of the impairment loss for a cash-generating unit only if another IFRS specifically requires the recognition of such a liability. Reversing an impairment loss involves assessing, at the end of each reporting period, whether an impairment loss recognized in prior periods for an asset other than goodwill may no longer exist or may have decreased. This assessment applies both to individual assets and to cash-generating units. If such an indication exists, the entity must estimate the recoverable amount of the asset. In making this assessment, the entity should, at a minimum, consider specific indications that the previous impairment loss might no longer be valid or may have reduced. At the end of each reporting period, an entity must evaluate whether there is any indication that a previously recognized impairment loss for an asset, other than goodwill, may no longer exist or may have decreased. If such an indication is present, the entity is required to estimate the asset's recoverable amount. In making this assessment, the entity should, at a minimum, consider certain key indications that could signal that the prior impairment loss might no longer be valid or may have been reduced. External sources of information that may indicate a reversal or reduction of a previously recognized impairment loss include observable signs that the asset's value has increased significantly during the period. Additionally, significant favorable changes in the technological, market, economic, or legal environment in which the entity operates, or in the market to which the asset is dedicated, either during the period or expected in the near future, may suggest that the impairment loss has decreased. A further indication is a decrease in market interest rates or other market rates of return on investments, if such decreases are likely to lower the discount rate used in calculating the asset's value in use and thereby materially increase the asset's recoverable amount. Internal sources of information that may indicate a reversal or reduction of a previously recognized impairment loss include significant favorable changes in the way an asset is used or is expected to be used, or in the extent of its use, either during the period or anticipated in the near future. Such changes may involve costs incurred to improve or enhance the asset's performance, or actions to restructure the operation to which the asset belongs. Evidence from internal reporting that shows the asset's economic performance is or is expected to be better than previously anticipated also serves as an indication. These internal indications of a potential decrease in an impairment loss largely mirror the indicators of a potential impairment loss. Even if no impairment loss is reversed, the presence of such indications may suggest that the asset's remaining useful life, depreciation, or amortization method, or residual value should be reviewed and adjusted in accordance with the applicable IFRS for that asset. An impairment loss recognized in prior periods for an asset other than goodwill shall be reversed only if there has been a change in the estimates used to determine the asset's recoverable amount since the last impairment loss was recognized. When such a change occurs, the carrying amount of the asset is increased to its recoverable amount, which constitutes a reversal of the impairment loss. This reversal reflects an increase in the estimated service potential of the asset, either from continued use or from its sale, compared with the estimates used when the last impairment loss was recognized. Changes in estimates that may lead to a reversal include, for example, a change in the basis for determining recoverable amount, whether it is based on fair value less costs of disposal or value in use. If the recoverable amount was based on value in use, changes in the amount or timing of estimated future cash flows or in the discount rate can trigger a reversal. Similarly, if the recoverable amount was based on fair value less costs of disposal, a revision in the estimates of its components may result in an increased recoverable amount. An asset's value in use may exceed its carrying amount simply because the present value of future cash inflows increases as those cash flows approach, but this does not mean the asset's service potential has increased. Therefore, an impairment loss is not reversed merely due to the passage of time, sometimes referred to as the unwinding of the discount, even if the asset's recoverable amount now exceeds its carrying amount. An asset's value in use can exceed its carrying amount simply because the present value of future cash inflows rises as those cash flows draw nearer. However, this does not indicate an increase in the asset's service potential. Consequently, an impairment loss is not reversed solely due to the passage of time, sometimes referred to as the unwinding of the discount, even if the recoverable amount of the asset becomes higher than its carrying amount. When reversing an impairment loss for an individual asset other than goodwill, the increased carrying amount resulting from the reversal cannot exceed the carrying amount the asset would have had, net of amortization or depreciation, if no impairment loss had been recognized in prior periods. Any increase above this amount is treated as a revaluation, and the applicable IFRS for the asset is applied. The reversal of an impairment loss for such an asset is recognized immediately in profit or loss, unless the asset is carried at a revalued amount under another IFRS, such as the revaluation model in IAS 16, in which case the reversal is treated as a revaluation increase. When a reversal of an impairment loss occurs on a revalued asset, it is recognized in other comprehensive income, increasing the revaluation surplus for that asset. However, if any part of the previous impairment loss on the same revalued asset was recognized in profit or loss, that portion of the reversal is also recognized in profit or loss. Following the reversal, the depreciation or amortization charge for the asset must be adjusted in future periods to systematically allocate the asset's revised carrying amount, less any residual value, over its remaining useful life. When reversing an impairment loss for a cash-generating unit, the reversal is allocated to the assets of the unit, excluding goodwill, in proportion to their carrying amounts. These increases are treated as reversals of impairment losses for individual assets and recognized in accordance with the rules for asset impairment reversals. In allocating the reversal, the carrying amount of each asset cannot exceed the lower of its recoverable amount, if determinable, or the carrying amount that would have existed, net of depreciation or amortization, had no prior impairment loss been recognized. Any portion of the reversal that would otherwise be allocated to an asset but exceeds these limits is instead allocated pro rata to the other assets in the unit, again excluding goodwill. An impairment loss recognized for goodwill cannot be reversed in a later period. This is because IAS 38 prohibits the recognition of internally generated goodwill. Any increase in the recoverable amount of goodwill after an impairment loss is recognized is considered an increase in internally generated goodwill rather than a reversal of the previously recognized impairment loss for the acquired goodwill. Entities are required to disclose specific information about impairment losses for each class of assets. This includes the amount of impairment losses recognized in profit or loss during the period, along with the line items in the statement of comprehensive income where those losses are recorded. Similarly, any reversals of impairment losses recognized in profit or loss must be disclosed, together with the corresponding line items in the statement of comprehensive income. For revalued assets, the entity must disclose the amount of impairment losses recognized in other comprehensive income during the period, as well as any reversals of such impairment losses recognized in other comprehensive income. A class of assets refers to a grouping of assets that share a similar nature and use within the entity's operations. The information about impairment losses required in paragraph 126 can be presented together with other disclosures for a class of assets. For instance, it may be included in a reconciliation of the carrying amount of property, plant, and equipment at the beginning and end of the period, as required by IAS 16. Entities that report segment information under IFRS 8 must disclose for each reportable segment the amount of impairment losses recognized in profit or loss and in other comprehensive income during the period, as well as the amount of reversals of impairment losses recognized in profit or loss and in other comprehensive income during the period. For an individual asset, including goodwill or a cash-generating unit for which an impairment loss has been recognized or reversed during the period, the entity must disclose the events and circumstances that led to the recognition or reversal of the impairment loss and the amount of the impairment loss recognized or reversed. For an individual asset, the disclosure should also include the nature of the asset. For an individual asset, if the entity reports segment information in accordance with IFRS 8, the reportable segment to which the asset belongs must be disclosed. For a cash-generating unit, the entity should disclose a description of the unit, such as whether it is a product line, a plant, a business operation, a geographical area, or a reportable segment as defined in IFRS 8. The amount of the impairment loss recognized or reversed must be disclosed by class of assets and, if applicable, by reportable segment. If the aggregation of assets used to identify the cash-generating unit has changed since the previous estimate of the unit's recoverable amount, the entity should describe both the current and former aggregation of assets and explain the reasons for the change. The recoverable amount of the asset or cash-generating unit must also be disclosed, along with an indication of whether it is based on fair value, less costs of disposal, or on value in use. If the recoverable amount is determined using fair value less costs of disposal, additional information is required to be disclosed as specified in the standard. For assets or cash-generating units measured at fair value less costs of disposal, an entity must disclose the level of the fair value hierarchy within which the fair value measurement is categorized in its entirety, without considering whether the costs of disposal are observable. For fair value measurements classified within Level 2 or Level 3 of the hierarchy, the entity must describe the valuation technique or techniques used to determine fair value less costs of disposal. And if any changes in the valuation technique have occurred, the entity must disclose the change and the reasons for it. Additionally, for Level 2 and Level 3 measurements, the entity should disclose each key assumption on which management has based its determination of fair value less costs of disposal, highlighting those assumptions to which the recoverable amount is most sensitive. If a present value technique is used, the discount rate IAS applied in the current and previous measurement must also be disclosed. If the recoverable amount is based on value in use, the entity must disclose the discount rate used in the current estimate and, if applicable, in the previous estimate of value in use. An entity must disclose information about the aggregate impairment losses and the aggregate reversals of impairment losses recognized during the period for which no other detailed disclosures are provided. This includes identifying the main classes of assets that were affected by impairment losses and the main classes of assets that were affected by reversals of impairment losses. The entity must also describe the main events and circumstances that led to the recognition of these impairment losses and reversals. An entity is encouraged to disclose the assumptions it used to determine the recoverable amount of assets or cash-generating units during the period. However, when a cash-generating unit includes goodwill or an intangible asset with an indefinite useful life, the entity is required to provide information about the estimates used to measure the recoverable amount of that unit. Additionally, if any portion of the goodwill acquired in a business combination during the period has not been allocated to a cash-generating unit or group of units by the end of the reporting period, the entity must disclose the amount of unallocated goodwill and explain why it remains unallocated. For cash-generating units or groups of units where the carrying amount of goodwill or intangible assets with indefinite useful lives is significant compared with the entity's total carrying amount of such assets, an entity shall disclose specific information. This includes the carrying amount of goodwill allocated to the unit, the carrying amount of intangible assets with indefinite useful lives allocated to the unit, and the basis used to determine the unit's recoverable amount, whether it is value in use or fair value less costs of disposal. If the recoverable amount is determined based on value in use, the entity must disclose each key assumption on which management has based its cash flow projections for the period covered by the most recent budgets or forecasts, with key assumptions being those to which the unit's recoverable amount is most sensitive. When disclosing information about cash-generating units or groups of units with significant goodwill or intangible assets with indefinite useful lives, an entity should describe management's approach to determining the values assigned to each key assumption. This includes whether the values reflect past experience or if they are consistent with external sources of information. If the values differ from past experience or external sources, the entity should explain how and why they differ. The entity should also explain the period over which management has projected cash flows based on financial budgets or forecasts approved by management. If a period longer than 5 years is used, the entity should justify why this longer period is appropriate. Next, the entity should disclose the growth rate used to extrapolate cash flow projections beyond the period covered by the most recent budgets or forecasts, along with a justification if the growth rate exceeds the long-term average growth rate for the products, industries, countries, or markets in which the entity operates or to which the unit is dedicated. The entity should also disclose the discount rates applied to the cash flow projections. If the recoverable amount of the unit or group of units is based on fair value less costs of disposal, the entity should describe the valuation techniques used to measure that fair value less costs of disposal. Even though the disclosures required by IFRS 13 are not mandatory, if fair value less costs of disposal is not measured using a quoted price for an identical unit or group of units, the entity should provide additional explanations regarding the techniques and assumptions used. When an entity discloses information about a cash-generating unit or a group of units whose recoverable amount is based on fair value less costs of disposal, it should first explain each key assumption on which management has based its determination. Key assumptions are those that the unit's recoverable amount is most sensitive to. The entity should describe how management determined the values assigned to each assumption, whether the values reflect past experience or are consistent with external sources of information. If the values differ from past experience or external sources, the entity should explain how and why they differ. The disclosure should also include the level of the fair value hierarchy within which the fair value measurement is categorized in its entirety, without considering whether the costs of disposal are observable. If there has been a change in the valuation technique, the entity should describe the change and explain the reasons for making it. If fair value less costs of disposal is measured using discounted cash flow projections, the entity should disclose the period over which management has projected cash flows, the growth rate used to extrapolate cash flows beyond that period, and the discount rates applied to the cash flow projections. When disclosing information about sensitivity of a cash-generating unit or group of units, an entity should report the effect of a reasonably possible change in a key assumption that would cause the unit's carrying amount to exceed its recoverable amount. This includes the amount by which the unit's recoverable amount currently exceeds its carrying amount. The entity should also disclose the value assigned to the key assumption, and the amount by which this value would need to change, taking into account any consequential effects on other variables used to measure recoverable amount in order for the unit's recoverable amount to equal its carrying amount. Additionally, if goodwill or intangible assets with indefinite useful lives are allocated across multiple units, and the amount allocated to each unit is not significant compared to the entity's total carrying amount of such assets, this fact should be disclosed. The disclosure should include the aggregate carrying amount of goodwill or intangible assets with indefinite useful lives allocated to those units. When the recoverable amounts of multiple cash-generating units or groups of units are based on the same key assumptions, and the aggregate carrying amount of goodwill or intangible assets with indefinite useful lives allocated to those units is significant compared to the entity's total carrying amount of such assets, the entity must disclose this fact. The disclosure should include the total carrying amount of goodwill allocated to these units, the total carrying amount of intangible assets with indefinite useful lives allocated to them, a description of the key assumptions, and an explanation of management's approach in determining the values assigned to those assumptions. This explanation should indicate whether the values reflect past experience or, if appropriate, are consistent with external sources of information, and if not, how and why they differ from past experience or external sources. Furthermore, if a reasonably possible change in the key assumptions would cause the aggregate carrying amount of these units to exceed their aggregate recoverable amounts, the entity should disclose this potential effect. When disclosing information about multiple cash-generating units or groups of units whose recoverable amounts are based on the same key assumptions, the entity must report the amount by which the aggregate recoverable amounts exceed the aggregate carrying amounts. It must also disclose the values assigned to the key assumptions and explain the amount by which those values would need to change, after considering any consequential effects on other variables used to measure recoverable amounts, so that the aggregate recoverable amounts equal the aggregate carrying amounts. Additionally, if the most recent detailed calculation of a unit's recoverable amount from a prior period is carried forward and used in the current period's impairment test, the disclosures for that unit relate to that carried forward calculation, provided the criteria in the relevant paragraphs are met. Illustrative example 9 demonstrates how to present the disclosures required for these situations. The transition provisions and effective date of this standard specify that it must be applied to goodwill and intangible assets acquired in business combinations with an agreement date on or after the 31st of March 2004. For all other assets, the standard is applied prospectively from the beginning of the first annual period starting on or after the 31st of March 2004. Entities encouraged by paragraph 139 may adopt the standard earlier than these effective dates. However, early application requires that IFRS 3 and the 2004 revision of IAS 38 are applied simultaneously. Additionally, IAS 1, Presentation of Financial Statements, revised in 2007, amended the terminology throughout IFRSs and updated paragraphs 61, 120, 126, and 129. These amendments are mandatory for annual periods beginning on or after the 1st of January 2009, but if an entity applies IAS 1, revised 2007, for an earlier period, the amendments must be applied for that period as well. IFRS 3, as revised in 2008, made several changes. It amended paragraphs 65, 81, 85, and 139, deleted paragraphs 91, 95, and 138, and added Appendix C. These amendments are effective for annual periods beginning on or after the 1st of July 2009. If an entity applies IFRS 3, revised 2008, for an earlier period, the amendments must also be applied for that earlier period. Paragraph 134E was amended by the improvements to IFRSs issued in May 2008. This amendment is effective for annual periods beginning on or after the 1st of January 2009, but earlier application is allowed. If applied early, the entity must disclose that fact. The amendments to the cost of an investment in a subsidiary, jointly controlled entity, or associate, included in IFRS 1 and IAS 27, issued May 2008, added paragraph 12H. This amendment must be applied prospectively for annual periods beginning on or after the 1st of January 2009. Earlier application is allowed, but if an entity applies the related amendments in paragraphs 4 and 38A of IAS 27 early, paragraph 12AH must also be applied at the same time. Finally, the improvements to IFRSs issued in April 2009 amended paragraph 80B. This amendment is effective prospectively for annual periods beginning on or after the 1st of January 2010. Earlier application is permitted, and if applied early, the entity must disclose that fact. IFRS 10 and IFRS 11, issued in May 2011, amended paragraph 4. the heading above paragraph 12H and paragraph 12H. Entities are required to apply these amendments when they apply IFRS 10 and IFRS 11. IFRS 13, also issued in May 2011, amended paragraphs 5, 6, 12, 20, 22, 28, 78, 105, 111, 130, and 134, deleted paragraphs 25, 27, and added paragraph 53A. Entities apply these amendments when they apply IFRS 13. In May 2013, paragraphs 130 and 134, along with the heading above paragraph 138, were amended. These amendments must be applied retrospectively for annual periods beginning on or after the 1st of January 2014. Earlier application is permitted, but entities cannot apply these amendments in periods, including comparative periods, where IFRS 13 is not applied. IFRS 15, Revenue from Contracts with Customers, issued in May 2014, amended paragraph 2. Entities apply this amendment when they apply IFRS 15. IFRS 9, issued in July 2014, amended paragraphs 2, 4, and 5, and deleted paragraphs 140F, 140G, and 140K. Entities apply these amendments when they apply IFRS 9. IFRS 17, issued in May 2017, amended paragraph 2, and further amendments issued in June 2020 also amended paragraph 2. Entities apply these amendments when they apply IFRS 17. This standard replaces IAS 36 Impairment of Assets, which was originally issued in 1998. Appendix A provides guidance on using present value techniques to measure an asset's value in use. This guidance is an integral part of the standard and applies not only to individual assets, but also to a group of assets that form a cash-generating unit. When measuring value in use using present value techniques, several components are considered together to capture the economic differences between assets. First, an entity estimates the future cash flows it expects to derive from the asset, which in more complex situations may involve a series of cash flows. Next, the entity considers expectations about possible variations in the amount or timing of those cash flows. The time value of money is represented by the current market risk-free interest rate, while the price for bearing the uncertainty inherent in the asset is also included. Additionally, other factors, sometimes unidentifiable, such as illiquidity, are reflected in the pricing of the expected future cash flows. There are two main approaches to computing present value. Under the traditional approach, adjustments for possible variations, uncertainty, and other factors are embedded in the discount rate. Under the expected cash flow approach, these factors adjust the expected cash flows directly, producing risk-adjusted expected cash flows. Regardless of the approach, the goal is to reflect the expected present value of the future cash flows, meaning a weighted average of all possible outcomes. When applying present value techniques to measure an asset, there are several general principles to follow. First, the interest rates used to discount cash flows should be consistent with the assumptions built into the estimated cash flows. This prevents double counting or ignoring certain assumptions. For example, if a discount rate of 12% is applied to contractual cash flows of a loan receivable, that rate already reflects expectations about future defaults for similar loans, so it should not be applied again to expected cash flows that already account for those defaults. Second, estimated cash flows and discount rates should be free from bias and unrelated factors. Deliberately understating or overstating cash flows, for instance, to make an asset appear more profitable, introduces bias and distorts the measurement. Finally, estimated cash flows and discount rates should reflect the full range of possible outcomes rather than focusing on a single, most likely minimum or maximum amount. This ensures that the present value estimate appropriately captures the uncertainty and variability inherent in the asset. The traditional approach to measuring present value uses a single set of estimated cash flows and a single discount rate, often referred to as the rate commensurate with the risk. This method assumes that one discount rate can capture all expectations about future cash flows along with the appropriate risk premium. Consequently, the focus is primarily on selecting the right discount rate. This approach is relatively straightforward to apply in situations where comparable assets can be observed in the market. For assets with contractual cash flows, it aligns with how market participants often describe assets, for example, a 12% bond. However, the traditional approach may not work well for more complex situations, such as measuring non-financial assets when no market exists for the asset or a comparable item. Finding the rate commensurate with the risk requires analyzing at least two items: an asset in the marketplace with an observable interest rate and the asset being measured. The appropriate discount rate for the cash flows of the asset being measured must be inferred from the observable rate of the other asset. To do this correctly, the cash flow characteristics of the observable asset must be similar to those of the asset being measured. Therefore, the person measuring the asset needs to carefully compare the two assets to ensure the inferred discount rate accurately reflects the risk of the asset in question. To apply the traditional approach properly, several steps are necessary. First, identify the set of cash flows that will be discounted. Next, find another asset in the marketplace that has similar cash flow characteristics. Then, compare the cash flows from the two assets to ensure they are truly comparable. For example, are both sets contractual, or is one an estimate while the other is contractual? It is also important to evaluate whether one asset has elements that the other does not, such as differences in liquidity. Finally, assess whether both sets of cash flows are likely to behave similarly under changing economic conditions. These steps help ensure that the discount rate applied appropriately reflects the risk and characteristics of the asset being measured. The expected cash flow approach can be more effective than the traditional approach in certain situations. Instead of using a single most likely cash flow, it incorporates all possible cash flows and their probabilities. For example, if a cash flow could be CU100, CU200, or CU300 with probabilities of 10%, 60%, and 30% respectively, the expected cash flow would be CU220. This approach focuses on analyzing the cash flows directly and explicitly stating the assumptions used in the measurement. It is also useful when the timing of cash flows is uncertain. For instance, if a cash flow of CU1000 might be received in 1, 2, or 3 years with probabilities of 10%, 60%, and 30%, the expected cash flow approach allows the computation of the expected present value, considering these timing uncertainties. In this example, the expected present value is Q892.36, which differs from the traditional best estimate of Q902.73, based on the 60% probability scenario. The traditional present value method requires selecting a single timing for the cash flows, so it doesn't take into account the probabilities of alternative timings. This limitation exists because the discount rate in a traditional computation cannot capture the uncertainty related to when cash flows will occur. The expected cash flow approach relies on using probabilities to reflect the range of possible outcomes for cash flows. Some argue that assigning probabilities to highly subjective estimates might give an illusion of precision. However, even the traditional approach depends on the same estimates and subjectivity without offering the same computational transparency. In practice, accountants often deal with limited information about the likelihood of different cash flows. For instance, if an estimated amount lies between CU50 and CU250 with no value more likely than another, the expected cash flow is simply the midpoint, CU150. In another case, if the same range exists but CU100 is considered the most likely amount and probabilities for other amounts are unknown, the expected cash flow can be estimated as Q133.33, calculated as the average of CU50, CU100, and CU250. In this example, the estimated cash flows are CU50 with a 10% probability, CU250 with a 30% probability, and CU100 with a 60% probability. Using these probabilities, the expected cash flow is calculated as CU140 by multiplying each amount by its probability and summing the results, 50 x 0.10, plus 250 x 0.30, plus 100 x 0.60. Generally, the estimated expected cash flow provides a better measure of an asset's value in use than considering only the minimum, most likely, or maximum amount. However, applying the expected cash flow approach must take into account a cost-benefit constraint. While in some cases, extensive data may allow for detailed cash flow scenarios, in other cases, the entity may only be able to make broad statements about cash flow variability without incurring substantial cost. Entities need to weigh the cost of obtaining additional information against the increase in reliability it would bring to the measurement. Some critics argue that expected cash flow techniques may be unsuitable for measuring an asset with only a few possible outcomes. For example, consider an asset with a 90% probability of generating a cash flow of CU10 and a 10% probability of generating CU1000. The expected cash flow in this case would be CU109, which does not correspond to either of the actual possible outcomes. This criticism reflects a disagreement with the measurement objective. If the goal were simply to accumulate expected costs, the expected cash flow might not provide a faithful estimate. However, the purpose of this standard is to measure the recoverable amount of an asset. In the example, measuring the asset at CU10, the most likely cash flow, would ignore the uncertainty inherent in the cash flows. Such a measurement would not reflect the asset's true economic value because no rational entity would sell an asset with these characteristics for CU10, given the potential for a much higher cash flow. When measuring the value in use of an asset, whichever approach is adopted, the interest rates used to discount cash flows should avoid reflecting risks that have already been incorporated into the estimated cash flows. If these risks were included in both the cash flow estimates and the discount rate, it would result in double counting. If an asset-specific discount rate is not directly observable in the market, an entity can use surrogate rates to approximate it. The goal is to estimate, as closely as possible, a market-based assessment of the time value of money over the asset's remaining useful life, as well as certain factors like risk and uncertainty that have not already been reflected in the cash flow estimates. As a starting point, the entity might consider the weighted average cost of capital, calculated using methods such as the capital asset pricing model, the entity's incremental borrowing rate, or other market borrowing rates. These provide reasonable proxies to approximate the discount rate for the asset. The discount rates used to measure the value and use of an asset must be carefully adjusted. They should reflect how the market would assess the specific risks associated with the asset's estimated cash flows, while excluding risks that are irrelevant or already incorporated in the cash flow estimates. Examples of risks to consider include country risk, currency risk, and price risk. The discount rate is independent of the entity's capital structure or the way the asset was financed because the future cash flows from the asset are not affected by the entity's financing choices. Additionally, the discount rate should be a pre-tax rate. If the estimated rate is post-tax, it must be converted to a pre-tax rate. Typically, a single discount rate is used for the entire value in use calculation. However, separate discount rates may be applied for different future periods if the asset's value in use is sensitive to changes in risk over time or to the term structure of interest rates. Appendix B describes an amendment to IAS 16 which applies when an entity uses the 2003 revision of IAS 16 on property, plant, and equipment. This appendix is relevant only until IAS 36, as revised in 2004, becomes effective. Once IAS 36, 2004 is applied, the provisions in this appendix are no longer needed because the requirements are incorporated directly into the revised IAS 36. Essentially, Appendix B was a transitional guidance, and it only applied to entities that chose to apply IAS 16, 2003 revision early. The actual text of this appendix has been omitted in this volume. Appendix C provides guidance on how to conduct impairment testing for cash-generating units that include goodwill and non-controlling interests. As an integral part of the standard, it outlines the principles and procedures for assessing whether the carrying amount of such units exceeds their recoverable amount, ensuring that any impairment of goodwill or related assets is properly identified and accounted for. When a business combination occurs, IFRS 3, as revised in 2008, requires the acquirer to measure and recognize goodwill at the acquisition date. Goodwill is calculated as the excess of the aggregate of three items over the net assets acquired. The three items are the consideration transferred, measured generally at acquisition date fair value, the amount of any non-controlling interest in the acquiree, also measured in accordance with IFRS 3. And in the case of a business combination achieved in stages, the acquisition date fair value of the acquirer's previously held equity interest in the acquiree. This total is then compared with the net of the acquisition date amounts of the identifiable assets acquired and liabilities assumed, also measured under IFRS 3. The difference, if positive, represents goodwill. Goodwill acquired in a business combination must be allocated to each of the acquirer's cash-generating units or groups of cash-generating units that are expected to benefit from the synergies of the combination. This allocation is required regardless of whether other assets or liabilities of the acquiree are assigned to those units or groups. It is important to note that some of the synergies from the business combination may be allocated to a cash-generating unit in which the non-controlling interest has no stake. Testing for impairment requires comparing the recoverable amount of a cash-generating unit with its carrying amount. When non-controlling interests are measured as their proportionate share of the subsidiary's net identifiable assets at the acquisition date, rather than at fair value, any goodwill attributable to those non-controlling interests is included in the recoverable amount of the related cash-generating unit. However, this goodwill is not recognized in the parent's consolidated financial statements. Therefore, the carrying amount of goodwill allocated to the unit must be grossed up to include the goodwill attributable to the non-controlling interest. This adjusted carrying amount is then compared with the unit's recoverable amount to determine whether an impairment exists. When allocating an impairment loss, the first step is to reduce the carrying amount of goodwill assigned to the cash-generating unit. Any remaining loss is then allocated to the other assets of the unit on a pro rata basis according to the carrying amounts of those assets. If a subsidiary or part of a subsidiary with a non-controlling interest is itself a cash-generating unit, the impairment loss is allocated between the parent and the non-controlling interest in the same proportion as profit or loss. If the subsidiary or a part of a subsidiary with a non-controlling interest forms part of a larger cash-generating unit, the goodwill impairment losses are allocated across the parts with and without non-controlling interests. In this case, the allocation to the parts of the unit is based for the portion relating to goodwill, on the relative carrying values of goodwill in those parts before the impairment. When an impairment relates to identifiable assets within a cash-generating unit, the loss is allocated based on the relative carrying amounts of the net identifiable assets of each part before the impairment. Within each part, the loss is applied pro rata to the individual assets according to their carrying amounts. For parts of the unit that include a non-controlling interest, the impairment is divided between the parent and the non-controlling interest in the same proportion as profit or loss. If the impairment loss associated with a non-controlling interest relates to goodwill that is not recognized in the parent's consolidated financial statements, that portion of the loss is not treated as a goodwill impairment loss. Only the portion of the impairment affecting goodwill allocated to the parent is recognized as a goodwill impairment loss. Illustrative example 7 in the standard demonstrates this process for a cash-generating unit that is not wholly owned and contains goodwill. IAS 36, Impairment of Assets, revised in 2004, was approved for issue by 11 of the 14 members of the International Accounting Standards Board. The 3 members who dissented were Anthony T. Cope, James J. Leisenring, and Jeffrey Whittington. Their dissenting opinions are provided after the basis for conclusions in the standard. The standard was issued under the leadership of Sir David Tweedy as chairman, with Thomas E. Jones serving as vice chairman. Other members who approved the standard include Mary E. Bart, Hans-Georg Bruns, Robert P. Garnett, Gilbert Gellard, Warren J. McGregor, Patricia L. O'Malley, Harry K. Schmid, John T. Smith, and Tatsumi Yamada. The amendments on recoverable amount disclosures for non-financial assets to IAS 36, issued in May 2013, were approved for issue by 15 members of the International Accounting Standards Board. Gary Kabarek abstained from voting due to his recent appointment to the IASB. The approval was made under the leadership of Hans Hugervorst as chairman and Ian McIntosh as vice chairman. Other board members who approved the amendments include Stephen Cooper, Philippe Danjou, Martin Edelman, Jan Engstrom, Patrick Finnegan, Amaro Luis de Oliveira Gomez, Prabhakar Kalavacherla, Patricia McConnell, Takatsu Guochi, Daryl Scott, Chungwoo Su, Mary Tokar, and Weiguo Zhang. Thank you for completing our course and for the attention and dedication you've shown throughout. We're happy to have contributed to your professional development and encourage you to help us improve by providing your feedback. If you have any questions or suggestions, feel free to reach out via email at info@qllever.al or through the contact forms on our website. Also, we invite you to follow us on social media and our YouTube channel to stay updated on upcoming training sessions. Thank you once again, and we look forward to seeing you in future courses.